Hello, and thank you for joining today's Family Office Network's webinar series featuring AVG. AVG is working with more and more family offices to help them increase their allocation to venture capital through broadly diversified funds and narrowly focused stage sector funds. Today's AVG's CEO, Mike Collins, and Chief Investment Officer, Anton Simunovic, will talk about AVG's strategy, how they work with family offices, and their innovative Total Access Fund, which delivers a broad and highly diversified venture capital portfolio. AVG provides family offices to unique syndication investment opportunities. At the end of today's presentation, we will have time for Q&A. We encourage your questions, so please use your questions chat option on the right side of your screen to send over any questions you have so we can answer those accordingly. And starting us off today is Colin Van Ostern, Chief Operating Officer. Colin, I'm going to let you take it from here.
Thanks, Lindsay. And thanks for everyone joining us virtually. I think we're all getting used to doing this remotely and digitally at this point, but we appreciate talking with you from all across the country and other parts of the world as well. I'm joined here by Mike Collins and Anton Simunovic, and we're going to talk a little about Alumni Ventures and also specifically about our Total Access Fund. I just want to say at the beginning, we're speaking about AVG and the Total Access Fund and our views of the associated landscape. The presentation is for informational purposes only. It's not an offering to buy or sell securities, which are only made, as you know, pursuant to the formal offering documents for each fund. Please review the important disclosures that we're offering as well. So you can see Mike and Anton on the screen. I'll turn it over to them in a moment briefly. I will ask you, we're going to have Q&A at the end. So please, throughout, if you have questions, thoughts, areas you want to hear more about, there's a question and answer panel as part of the GoToWebinar interface. Feel free to enter your questions at any point throughout, and we'll do our best to kind of collect, compile, and answer those along the way. So Anton is our Chief Investment Officer. Anton has a 25+ year long career in venture investing. Some pretty impressive numbers to show for it that you can see on the screen here. Generating $500 million plus cash on cash returns on a base of $72 million invested, and that's before he came to AVG, and those numbers have only grown significantly since. Mike is our founder and CEO. Mike is a serial entrepreneur and venture investor, has worked in virtually every sector and stage of this business. He launched the first fund that AVG managed back in 2015. And I'll share a little about the agenda today. We're going to start at 30,000 feet, talking about why we believe venture capital is an important asset class to a portfolio and to the economy as a whole. Mike will share what Alumni Ventures is, how we work, and then he'll hand it over to Anton to really dig deep into our Total Access Fund, which is a very broad offering that allows you to access hundreds of venture capital deals a year, as well as see individual deals, unique proprietary deal flow that you can invest in and make investment decisions on deal by deal. So with that, I'm going to turn it over to Mike.
Thanks, Colin. So it has to start with this a discussion of venture capital as an asset class. And over many periods, venture capital has been a very strong asset class to own. It's been around really since the 1950s or 60s, depending on how you want to count. But over almost any slice of time, it's really been a very important part of a sophisticated, diversified asset class. If anything, those trends have been accelerating over the past 5 to 10 years. When I started in the business, companies would go public at a $500 million, billion-dollar valuation. Now, routinely, companies are going public at a 40, 60, 80 billion dollar valuation. And if your starting point as an investor is $50 billion, in a global, very efficient marketplace, I think it is increasingly difficult to get the kind of returns we all seek. It's also an asset class that just adds to diversification. There's huge value being created in almost all sectors of venture capital. Again, 30 years ago, it was a fairly narrow set of industries that were being addressed by entrepreneurship, technology, and now you really go through almost every segment of the economy, whether it is medicine or transportation or energy, food, hospitality. There's tremendous innovation, tremendous technology being brought to bear, and with that innovation and technology is huge value creation. And it's really arguably a huge miss if you're not allocated in this asset class. I started the business because historically venture capital has been the purview of large institutions, endowments, pension funds, insurance companies, multi-billionaires. And I created Alumni Ventures to bring smart, diversified venture portfolios to accredited individuals and small family offices. And that's really the success of our business has really been built on that core idea. The core idea that we can do better as a network and a community than any of us could do in this asset class on our own. Part of a real core part of that strategy is really about the portfolios we pull together. And this is really an important slide and really represents the part of venture capital that's really important to understand, which is it's a hits business. That if you have a portfolio of 100 companies, the returns are really driven by a very small percentage of investments, 5 or 10 that are home runs. And the data really supports having a very large venture portfolio in order to kind of have the opportunity to catch one of those fantastic opportunities. If you look at the horizontal axis here, it's pretty simple to read. It's portfolio size. It's the size of, it's the number of venture investments in your portfolio. If you look at kind of the orange, brown, the chances that your portfolio will lose money goes down dramatically once your portfolio starts hitting 50 to 100 individual investments. Your chances of doing 3 times your money also continue to go up. And this basically argues, independent of alpha, the larger portfolio, the better when it comes to venture capital. And then again, that's really what we're talking about today with Alumni Ventures and our Total Access Fund. Just the industry publication is PitchBook in venture capital, and they came out with their list today for 2020, and Alumni Ventures was listed as the most active seed early stage investor in the United States. We started out with one fund built around the community of my alma mater, Dartmouth, in 2015. We now have 18 alumni funds. We have funds that are open to any accredited investor, including the fund we're going to be talking about today, which is our Total Access Fund, which is a little piece of every deal we do. A little outdated here. We actually have a full-time staff of 120 located in kind of venture hubs, headquarters here in Manchester, New Hampshire, but offices in San Francisco, Chicago, Boston, New York, and a new office in Austin. Digging out today. We have a community of over 500,000 community members and investors that provide capital, provide access, provide deal flow, provide expertise. Again, we are a network-powered venture capital firm. And as I just mentioned, we are a very active venture firm. Because we co-invest, we're able to co-invest alongside name recognizable venture capital firms, and we do a lot of deals. So we're investing in 200-300 deals per year. Tremendous community. Obviously, a lot of the things in the last 18 months have been accelerated. It's been a very good time to be in technology. Most of the trends that we bet on that take 5 or 10 years, that time frame has been condensed and consolidated. And so I think all the things we believe about the move toward a digital economy, telemedicine, disruption in energy, education, transportation, have really been accelerated in the past 18 months or so. I'm going to talk just a little bit, and then I'm going to turn it over to Anton, our Chief Investment Officer. But today we're talking specifically about our largest and most diversified portfolio, our Total Access Fund. And this is a little piece of every deal we do, which includes diversification across stage, sector, geography, and lead investor. It's important not to confuse our deal volume with rigor. We have almost 50 full-time investment professionals. We have hundreds of years of venture capital investing experience. We run a process where we're scoring deals. We're using the power of community and crowds to make decisions. We co-invest really alongside a who's who list of venture capital firms. Like most sophisticated venture capital firms, we hold some capital in reserve to reinvest in companies that are really excelling. And our fund is offered to all accredited investors and qualified purchasers. And with that, I think I'm gonna turn it over at this point to Anton.
Thank you, Mike, and thanks everybody for joining us today, wherever you are, morning, afternoon. So as Mike mentioned, our Total Access Fund is our most diversified portfolio, and it's going to give you exposure to every investment that AVG makes. So to give you a sense of scale, we invested in 234 companies in 2020. We are going to invest in 250 to 300 companies this year in 2021. So to keep the math simple, if you were to make $1 million investment into our annual TAF product, that would give you exposure by deal of a few $1,000s, call it low few $1,000s per deal. So it is a very diversified fund, both by way of the number of deals, the sector, stage, geography, and ultimately the lead investor. I just want to double click on one of the things Mike was saying earlier. We are strictly a co-investor. That's one of the reasons why we are able to do this number of deals. Venture historically is not a scalable business model. Co-investing is. When you are a co-investor, we don't take board seats. We don't negotiate terms. What we look to do is add disproportionate value to the investments that we make, both to the venture capitalist as well as a portfolio management team. And the VCs that we invest with, there's about 800 in the United States that have any sense of size. We have narrowed that list to about 150 that we believe really matter. It's the Accels and the Andreessens and the Bessemers and the Kleiners and the USVs of the world. And we invested with 135 of those funds as a co-investor last year. So if what you're really looking for is a truly diversified, professional grade venture portfolio, and you want to get exposure to this venture asset class in that manner, then TAF is the vehicle for you. And it comes in two forms. As you see on this slide, you can do either an annual vintage, $100,000 minimum. We will again invest in upwards of 300 deals this year, deployed obviously on an annual basis, or you can go with our quarterly vintage. We offer 4 of those per year. Again, you'll have exposure to, therefore, 300 divided by 4, 50 to 75 deals per quarter. Next slide, please. I'd like to chat about process a bit. So do not mistake, that's a lot of deals, and do not mistake volume for lack of discipline within our process. We're an extremely process-oriented investment shop. So each one of our investments goes through a 3-step approval process. First, it's the alumni fund that will source the deal as represented by the icons in the middle of the page. So that might be Spike, which is where we have built community around Stanford. That might be Yard, where we built community around Harvard. That might be Blue Ivy, where we built community around Yale. That underlying fund investment team will source an investment, do all the requisite diligence. They'll in fact write a long diligence report. They will speak with industry experts. They'll speak to management. They'll speak to the lead investor. They will hold an investment committee where the portfolio company CEO will present not only to the alumni fund team, but their external investment committee, which is made up of industry experts from our community that's 550,000 large. They will also present to AVG's central investment committee, which is made up of some of our most seasoned and senior investment professionals. We will then score the investment based upon all of the information that we hear and see and questions that we ask of management. We have a scorecard that has 40 or 50 attributes on it. Each individual will score the deal, and we're big believers in the wisdom of the small crowd. That when you put half a dozen smart people together who are both seasoned VCs as well as seasoned tech operators, ideally who have deep domain expertise, when you score all of that, it will yield better decision making. And the way our scoring works, 80 points and above, a deal is approved, 79.9 and below, the deal is rejected. We're very passionate in how we get access to deal flow. We're very dispassionate in the way in which we evaluate those deals. And so, as mentioned, each of these investments will go through this rigorous process. And then if it's approved, a small portion of that investment, maybe a few $100s, maybe a few $1,000s predicated upon your individual investment, will be made by TAF, by the Total Access Fund, into that specific deal. And so again, this is how we build from the bottoms up an incredibly diversified portfolio that reflects the venture asset class. Here's a few deals that we can chat of. Candidly, again, there were 234 last year. We could have chatted about 200 of these deals, but want to give you a sense of the way in which we source opportunities, the quality of the investment. And perhaps I'll touch on why we're able to get into these deals. And so Freshly was a company, in fact, that was sourced by our Yard team, again, built around the Harvard community. What Freshly does is they provided healthy, fresh, freshly cooked meals. Our Yard team thematically looked at this direct-to-consumer sector a number of years ago, selected Freshly as the investment that they wanted to go with. Freshly very interested in not only Yard, our underlying fund, as well as Alumni Ventures, because our community is so large, and they saw our community as prospective customers. Wisely, the company took Nestle's in the Series C round as a strategic. They methodically built out operations across the country. They didn't allow Nestle to bend the will and strategy of the underlying company. And ultimately what ended up happening late last year, I think it was, is that Nestle bought Freshly for near $1.5 billion, a $900 million payout in cash and a $550 million earnout. But again, interesting approach in how we sourced the deal, thematically evaluated it, and ultimately made the investment. Upstart, it is an artificially intelligence powered lending platform sourced by our Blue Ivy team. That is Yale. The who's who of investors in this deal: Khosla, Kleiner, first round, Google Ventures. Company went public late last year. In fact, coming off lockup second quarter of this year, company's been performing exceptionally well. We're expecting great things out of Upstart. And the way we got into Upstart was our managing partner at Blue Ivy, David Shapiro. Frankly, he's tenacious, bit of a dog on a bone, liked the deal, followed it, leveraged some personal relationships that he had with some of his VCs, and managed to bring Alumni Ventures into the investment. I love the Lacework story. Lacework is a cybersecurity for the cloud. You may know of an entity called Sutter Hill Ventures. They had invested in an entity called Snowflake, really unusual venture model. What they do is identify a sector that they think is particularly compelling, though underserviced. Michael Spicer actually is the general partner of Sutter, acted as the initial CEO at Snowflake. When it got to a certain size, they bring in professional management. What great VCs do is rinse and repeat. They are doing the exact same thing here with Lacework. I should have mentioned that Warren Buffett unusually came in at the IPO, Snowflake's IPO. Company has performed exceptionally well. And one of the first time that Buffett has done that. And they're essentially recreating that in Lacework. Lacework's number one customer is Snowflake. Michael Spicer was the initial CEO of Lacework. We went out and identified in the Valley, this was again sourced by our Spike team around Stanford, who are the best cybersecurity individuals that we should know. We were referred to the CTO of this business, who now has become the CEO. And by bringing them via our network, their very first customer, we got a seat at the table as a co-investor. Lacework just raised a $525 million, I think it was a Series C or D, again, alongside Cotu and DST and others at $1.1 billion valuation. We have, again, expecting great things out of Lacework. But adding value is the name of the game. You see from the quote on the left, we leverage disruptively our network that is 550,000 strong to bring new customers, talent, PR, the next lead for the following round to these companies. And that's how we're able to source and gain access, really for you, our investors in the TAF fund. Next slide, please. Yeah, so one of the special benefits I think that you get is being part of TAF, something that we call syndications. Now, syndications are where we have been able to negotiate incremental allocation into a deal. And it's a deal that's obviously cleared process. Alumni Ventures is investing in it. And then what we do is we make that opportunity available to you. So coming back to the math, if there were to be a deal that particularly resonated with you that we are syndicating, rather than having $100, $200 or $2,000 in the deal, if you wanted to double down, you really felt like it was a winner, that you wanted to be the venture capitalist, you could invest anywhere from $10,000 as a minimum up to $250,000 in some of our syndications. Now, what we do is we share all of our diligence materials with you behind a secure portal. So that means the due diligence report, the investment committee is recorded. You get to hear all of the questions as asked by our IC members of the CEO, recorded and shared with you. Our diligence notes, the deck from the company, projected financials, historic financials, a cap table from the company, the terms, the term sheet under which we would invest. We share all of these things with you because one of the underlying cultural pillars of Alumni Ventures is to educate our investor. We are doing this for the individual. not sophisticated institutional investors, rather the individual or family office that are really looking for access to our proprietary deal flow in a bespoke way. Of course, these things are all at your discretion. You can either choose to invest or not. I think I touched on this a lot. We'll notify you that these deals move fairly quickly. You have about a week to evaluate the opportunity, review all those materials within the portal, and then a week or two thereafter to fund the investment. Again, at your discretion. Perhaps I'll just touch quickly on a few syndications that we ran Q4. Civis, interesting data service platform. Dan Wagner, the founder and CEO. Dan Wagner was the chief analytics officer for Obama's campaign. Needless to say, he was close friends with Eric Schmidt, former chairman and CEO of Google. Eric Schmidt did the entire seed round here. And the company has grown very aggressively, providing data services not only to Fortune 500 companies, but the government sector as well. Company is largely off financial risk in light of some of the players around the table, including Eric Schmidt and others. We ran this as a syndication. I think we raised $6 million into this deal. Luminous, love this deal. It's very risky. It's a moonshot. The company is looking to create photonic chips. So if Elon Musk is ever going to get to a Tesla vehicle not having a steering wheel, so true level 5 driving, it's likely that a photonic chip is going to be required inside that vehicle. It's essentially a supercomputer the size of several buildings that gets reduced to a chip and commensurate reduction in power consumption. So think about your range anxiety. You know, your range, I'll come back to that. Your range anxiety right now on a Tesla is maybe 350 miles. If you had without a Luminous chip, it's probably going to be 50 miles if you could truly deliver level 5 driving. So moonshot type opportunity. If it works, it's going to be massive. Luke Nosek was the lead investor here, GigaFund. Quickly on Luke, original PayPal Mafia, became a co-founder and founders fund with Peter Thiel, spun out to do GigaFund. This is his third investment. His first two, one was SpaceX, the other one was Boring Company alongside Elon Musk. They bet on management teams. Really interesting deal. We raised about $10 million here. And BlockFi, real quick, is not for the faint of heart. BlockFi is a company that is playing at this intersection between crypto and fiat currencies. You can actually earn crypto interest on your crypto deposits within BlockFi. Love or hate crypto, company has grown extraordinarily well. We were in the seed here, $5 million post-money valuation, sourced by our Purple Arch team. Purple Arch being built around the Northwestern community. I don't know whether you saw last week, BlockFi just announced raising money at a $2.85 billion pre-money from some very well-regarded venture capitalists that will soon be in the press. Just trying to give you a sense again for the quality of syndication as well as deals that we do within the Total Access Fund. And real quick, just syndications in review. We've grown this offering fairly aggressively. Our customers and investors love it. We did 10 syndications in 2019, 30 syndications in 2020. We're projected to do somewhere between 75 and 90 syndications in 2021. We've raised more than $100 million into our syndication offering. Again, at your discretion, your opportunity to learn about a deal, get increased access into any one of these investments that we choose to syndicate, and thereby increase your allocation fundamentally in a venture. Let me leave it there. I think the next slide, I'm turning it back to Mike, I believe. Yes.
Great. Thank you, Anton. So just talking about a couple of other things we do, we really try to empower our investors. On one hand, we have what we call kind of the fire and forget approach with our Total Access Fund. which gives us a tiny piece of a huge number of deals, that has more characteristics of, an ETF or something for this asset class. There's other people that really are looking for more focus or more customization. And so Anton talked a bit about being able to do that through the deals we syndicate, where you can go in and pick an individual company, again, with full transparency on a deal that we're doing. But we also have what we call focus funds. These are around specific themes that are greatly valued by parts of the community. In 2020, we had a post-COVID fund, really investing exclusively on companies that were being accelerated through all the things that were taking place in 2020. We had a deep tech fund. We had a seed fund. Right now, we currently have an anti-bias fund. We believe strongly that there is tremendous opportunity in backing underrepresented groups and backing businesses that are addressing systemic bias. It's been very well received. That fund closes at the end of March. And then on deck, opening right after that for the second quarter, we have our emerging VC markets fund, which will be a portfolio of 20 or 30 companies that include companies that are headquartered internationally or primarily serve international markets, and who are located in emerging US markets. One of the things we've all seen is that the dispersion of venture capital beyond Silicon Valley to markets like Seattle and Austin, Atlanta, Miami, and internationally in places like the Far East and Canada and South America. Parts of Europe are becoming very dynamic venture markets, again, as a way to focus and customize your individual venture portfolio.
Great, thanks, Mike. So we'll include information in the deck for folks who are interested in setting up a time to talk with somebody from our team or in making an investment decision. We also wanted to open this session up for question and answer. I see a couple folks have entered questions in the question panel throughout. And as we go through those, let me invite others, if you have questions about Alumni Ventures, what we're seeing in the marketplace, the work that we do to bring more and more into this community of entrepreneurship, please don't hesitate to enter that in, or if there are specific questions you have about our funds, please feel free to enter those as well. So I'm going to do my best to field these as they come in and kind of send them to Mike or Anton or answer as makes sense. The first, probably this goes for Anton. The question is, how do you help operating companies given the high number of deals that AVG is involved in?
It's a great question. In some ways, our network is certainly a core pillar that differentiates us. So again, 550,000 strong, and there's not an investment we've made in a portfolio company that isn't ultimately looking for a warm introduction to revenue, a warm introduction to talent, a warm introduction to other VCs that might lead the next round. And so within my office, we have a portfolio impact team that is able to segment and match individuals either that exist within AVG, within our external investment committees, of which there are many, within our wider network and industry experts that are able to make these introductions on behalf of the portfolio impact, on behalf of the portfolio companies. And so what you end up having is, in exchange for our co-invest, 5, 10, 15% of a given round, we look to add disproportionate value in exchange for that dilution that doesn't crowd out the VC and is only viewed as value add by the portco CEOs. And that's how we get access to high quality deal flow.
So a couple of questions about syndications. I'm going to just read a few, and I think, Mike, maybe if you can start. So the first question is, do I need to be an investor in an AVG fund in order to participate in the syndicate deals? And then also, can you explain a little more how the syndications work? How do you select which deals are syndicated, and how many deals can I see?
So the answer to the first part is yes. We believe strongly, if you go back to my fancy slide about N being a large enough number, we have created a rule and a policy that in order to get access to syndications, you must be an investor in one of our funds. So that's a policy rule that we do have in place. The deals that are selected for syndication are basically deals where we can get allocation. So the deals we get into are very competitive. And coming back to the first question, as a co-investor, we're not competing really with the leads. That the lead has been selected by the CEO. We're fitting in as the co-investor part of the syndicate, signing the same kind of deal terms and conditions. We're doing it alongside that lead investor, Benchmark, Sequoia, what have you. And really the 3 C's of connections, customers, capital. That network powered VC story is really how we get into those deals. If we're able to negotiate a slightly larger allocation than is appropriate for, say it was sponsored by our Northwestern fund, Purple Arch, we can then offer that additional capital to the community. And we love to do it because we think it's a great way for people to get engaged, learn, vote with their dollars behind the companies that they really like and support. And it creates a virtuous circle and flywheel because, as we've mentioned, network powered venture capital, if you're an investor in BlockFi individually, your inclination to be helpful to BlockFi with contacts and networks and introduction just goes up, in an extremely a powerful way. So again, it's a very interesting strategic flywheel that we have between this community of investors and how we get access to the most competitive deals and how we add value to those portfolio companies. It's all about the power of a network.
Great, thanks, Mike. So I'm going to group the next two together as well. And Anton, you touched on this a little bit, but can you explain how AVG is different than other venture capital firms, and why do other venture firms let AVG co-invest along with them?
Right. So I think probably, there's a few things that really differentiate AVG versus traditional VCs. Most VCs lead. When you lead, you set terms, you negotiate, you sit on the board, you influence. That's one. The other is the investor base in traditional VC are limited partners. Are institutions for the most part. Everybody wants to land the Harvard endowment. What really differentiates us is our investor set is the individual, the company created by Mike to basically bring professional grade venture to the individual, to small offices. You don't need to write a check for $25, $50 million to get access to the best deal flow. And we, again, leveraging affinity that we have built around these alumni communities, first hear about the deals. We did an analysis recently. We have seen, again, Mike mentioned PitchBook earlier being the Bible. There are 25,000 private companies in the US right now. We have seen and done work on, not extensive work, but done work on more than 60% of all venture deals that have gone through PitchBook across the last 12 months. Now, many great venture investments want to be in stealth. You don't hear about them until they get funded. It's still very much a relationship-driven local business. And we disruptively use our network to learn about these deals before others do, often introducing lead VCs to what we think are attractive investment opportunities. And then we come in as a co-investor. We never crowd out the VC, and we never negotiate with the CEO. We get in under identical terms. We strive to get in under identical terms with the lead. And in that manner, we stay friends with everyone. We stay friends with me and the founding team.
And I'll just build on Anton's point, which is most of the decisions to let us in are really made by the entrepreneur. You know, entrepreneurs, especially in 2021, the good companies, not the lower end, but the good venture capital deals have multiple term sheets from name brand venture capital firms. It is very competitive, and the decision is really made by the entrepreneurial team. And so it's not a matter of, you know, Sequoia picking up the phone and bringing us in. It's that we have developed a relationship with the CEO of the company through this power of the network to get in. We may have introduced the deal to the appropriate partner at a venture capital firm. And because we don't lead, we play well with everybody. And so we're not elbowing out, you know, the lead VC firms. We're like your favorite aunt or uncle. You know, we leave you alone. We're taking a small piece of the deal, but when you need something, you need capital, you need introductions, you're looking to build your customer base, you reach out to us, and we have the best Rolodex in the industry. And for a co-investor that is only doing, you know, 5 or 10% of the round, that is a very compelling value proposition to an entrepreneur.
Great. So I have a couple of mechanical questions here, and then we'll have time, I think, for one more broad question, and then we'll wrap up. So Mike, for you, I'm going to group some of the mechanical questions together. How long does it take for each investment to be fully invested? What are the mechanics of the funding flow out of the fund? And what if I need to sell? And then are there restrictions on who you do and don't accept investments from?
Let me see if I get all those. So our funds are open to accredited and qualified purchasers. That's a definition by the SEC. There is an income or net worth requirement. You can Google what's accredited. We are open exclusively to accredited and qualified purchasers. The mechanism is a 10-year fund. So, and we do one capital call. So if someone decides to invest $100,000, they write a check for $100,000, and we will invest that. And let's assume they take the Taft product, an annual vintage. One capital call, one check goes in, that we do not go back. We take all the fees out of that one capital call. So it's one check in. It's a portfolio of, say, 250 companies. Company number 37 is sold. We immediately return a check back to the investor. So one check in, multiple checks back to the investors. A 10-year fund, it is an illiquid asset class. So because this money is invested in hundreds of companies around the globe, it is not an asset class where, you know what, I need some liquidity. I'm going to call up and sell my stock. In that way, it is very different type of asset to saying owning Apple Computer, public equity kind of situation, which has that kind of illiquidity. This is a illiquid asset class. You make an investment, you're really along for the ride with the venture capital firms, and when there is an exit, the company is bought or goes public, or there's some kind of exit event, Then as soon as proceeds are cleared and they come back to us, we remit them back to the investors into the fund. So again, for people that are interested, they can read all of the prospectus and paperwork. But it's important to note that these are 10-year funds. It's an illiquid asset class. It's one check in, multiple checks back to you.
Great. And to wrap up, Anton, this one is probably for you. It's a question about geography. You mentioned diversification. Can you share a snapshot of what that diversification looks like in the US? And do you invest in deals outside the US or not?
We do invest in deals outside the US. Candidly, AVG has grand ambitions to go international in a more meaningful way in the forthcoming years. At present today, I don't know exactly what the math is, but I'm going to say 5–10% of maybe 5% of the investments that we make are presently outside. Maybe it's actually a little bit more than that. I think about it, 10% when you include Canada, outside of the United States. When we say diversify geographically, we really mean it. So what we do is we look at what venture capital has done over the last 12 months, according to PitchBook, and look at those geographic diversifications. If 40% of venture was done in the greater California area, we look to largely mimic that. And we always go after only the best deals. Quality trumps everything. But we aren't exclusively an investor in the Bay Area or New York or Boston. We stay conscious of the venture geographic footprint that's going on. Mike mentioned earlier dispersion. We're now investing in deals in Kansas City, in Columbus, Ohio. We just invested in a deal in Raleigh, North Carolina the other day. I think it was yesterday, in fact. Talent is moving out of the epicenters due to COVID. There's tremendous opportunity as we see it over the next years with playing into this notion of geographic dispersion.
And listen, we as co-investors, we go where the top venture capital firms are going. And one of the things that we've seen over the last 18 months is historically venture capitalists located on Sand Hill Road really wanted to invest within 2 hours of where they could drive to their portfolio companies. And we would obviously, as a co-investors, we're investing where they're investing. But through COVID, they've broadened their horizon. Smart folks, they see dispersion, disruption. And so the same firms that had that philosophy a year and a half ago are leading rounds of financing in Provo and North Carolina and Miami. And when they go there, we go there.
All right. Well, thanks, Mike. Thanks, Anton. Thank you, Lindsay, and the folks at the Family Office Network. They will share information that we have provided in the course of the deck. And if you'd like to talk more, we'd be happy to connect.
Gentlemen, thank you so much for this high-level overview on AVG. And to all of our attendees, yes, we'll follow up with all of you individually, and we hope you have a great day. Bye-bye.
Thank you, everyone.
Thank you.